This tutorial is going to show you in detail how to answer exercise 4.6 and 4.7, the first balance day adjustment entries, which are very important, and you'll find those on page 112. Alright, the first exercise, you don't have to work out into anything using the calculator. So in this first one here, 4.6a, event expense prepaid for 1 month. So it tells you straight away it's an expense and it's been prepaid. So let's go ahead with that. So first of all, we've got event expense. So we'll type that in. I'm just going to call it rent expense, because sometimes you also have rent revenue, which is obviously different. As I've indicated to you earlier, in most instances expenses are always on the debit side. There we have $200 there. In this instance we're dealing with an accrued expense because it's an expense which we haven't yet paid, but it's owing. So it's accrued expense. There we are. And seeing that it's owing, let's make sense of it. It's a liability, $200 on the credit side. And there you are. There's your first balance day adjustment. Okay, let's move on to the second one. Here we have insurance prepaid for 7 months at $500 per month. So we would have paid an annual premium. 5 months would have been used up till June the 30th, and now we have to calculate the prepaid component. So simply what we do, we work out the prepaid component 7 times 500. Let's just put that in first, $3,500. I'll put that in there as well because we know we're going to have a credit. In this instance, it's insurance that is owed by the next accounting period. So we have in a sense a current asset like a debtor, and the account that we use is prepaid expense there, and we need to decrease insurance expense. That's why we have insurance on the credit side for $3,500. To help you understand this entry further, what I'm going to do, I'm going to show you how the background entry was made in the first place and how this entry then is reflected in the ledger accounts. So I'm going to flick over to the ledger accounts. You'll see here that $6,000 was paid. Now let's just work that out. Remember, it's $500 per month, so $6,000 was paid 5 months before balance date, so that's end of January there. We paid the insurance. We then made the entry in the journal entry, which is prepaid expense debit $3,500, but we had to credit insurance $3,500. So let's see how that worked out. So the prepaid expense component goes in there, and you'll find that the remainder that we've got to go to the profit and loss account, which is the amount that goes to the income statement for the month, is $2,500. And I'm just showing you this so you can see that $2,500 with 5 months at $500 per month, which is equals to $2,500. That's how much was used up in this accounting period, and we've had to shift $3,500 to the next accounting period, and that's why we do this entry. Right, and the cross-reference there is insurance, of course. So hopefully that's given you a bit more of an idea and put things in perspective, how things are working and the reasons why we're making this entry. Okay, let's keep moving to the next one. Part C, we've had commission owing to us for $400. Right. So in this instance we've got accrued revenue. That's one of the accounts for our balance day adjustment, $400 simply. In this instance we've incurred I better type that in properly. There we are. $400. So let's look at the logic of all this. $400 was owing, it hadn't yet been received, therefore we've got to recognise it according to our accrual accounting assumption. There it is on the credit side, and it's owing to us, therefore it acts like a debtor. Therefore it is a current asset on the debit side. Debit, credit, all okay. Let's look at the last entry, part D. Wages were owing at balance date. It's again very similar to the first one we did. So we've got wages expense, that's $80 on the debit side, so that increases. And again we've got accrued expense. There we are. And that is an amount that we owe at the 30th of June 2013. So there we have a liability owing. For this last entry, I will show you the ledgers and how it all works, again to consolidate the understanding of why we're making these entries in the first place. So we had to debit wages for $80. Let's look at the ledger here. Now there would have been a whole range of entries that have been entered throughout the year. I'm just going to make this figure up, it doesn't really matter. For our purposes, wages, we had some extra owing, so we've got to put that in there for $80. So that's our debit entry. Alright, so we can tick that one off, and we've got this other accrued expense for $80. So simply what happens here on the credit side, we do that, $80. Now had I shown you the whole system, you would have also noticed here on the accrued expense side an amount that would have come from our rent that we were owing, rent that was owing here for $200, so you would have had a $200 amount there as well as that $80 there, but I was just showing you the impact of one transaction in isolation, but that's what normally would happen. Okay, we've done 4.6, I'm going to go into 4.7. Part A, yeah, you've got to do a bit of more thinking on this one, but in this instance, advertising, we had a campaign which started before balance day. We still had perhaps some TV commercials going after balance day, so $1,500 worth had to be transferred into the next accounting period. So again, we've got a thing called a prepaid expense. So $1,500, that's the amount that is going to be on telly, if you like, after June the 30th, and we've got to credit advertising, $1,500 to reduce the amount there. So just recapping, we paid $10,000 for a whole advertising campaign, of which $1,500 was going to be in the next accounting period. So you can see by crediting advertising, we're going to reduce the amount that is allocated to the current accounting period, which is $8,500, and which leaves it next year we've got to allocate that to the advertising budget. So that's the first one. Let's look at part B. Sales salaries are owing every week, but the payment date is on Tuesday, and we've got the balance day on Thursday. So we've got Wednesday and Thursday's sales salaries that haven't yet been accounted for, and what I'm doing for these calculations is assuming that we only work 5 days a week. Right, so that's why down here in my calculation I've got $2,000 paid every week, but that's only 2 out of the 5 days which you're owing. So it means if you do your maths on that one, it's $800 that is currently owed to our staff. So we put sales salaries there for $800. The corresponding account here is that we owe it, very similar to the previous example where it's accrued expense. So let's type that in, and that's how much we owe as of balance day. Alright, let's keep moving to part C. There we have to do a calculation. A government bond is like a term deposit, that money we put in the bank, and that may have been put in the bank for 6 or 12 months, we don't know that, but what's relevant to us is that we must calculate only for 1 month. So when we've got amounts that are owing to us, we've got an account called accrued revenue, and we've got the other account is interest revenue. that goes up, so that's going to be the credit. So when we do a calculation, 1,000 times essentially 1%, see, times 12%, but it's only for 1 month, so 12 on 12 is 1, so it's just 1%. So is $100 that we are owed of interest. Hopefully, I'm hoping that's relatively straightforward. The last one of that exercise, rent, is an item that is always paid in advance. Right? So if I'm going to let out my premises, as is the case in this example, I'm expecting receiving the rent in advance, and it's been paid on the 29th, if you like, or the 30th of the month, but it's actually applicable for the next month, July. So we've got a prepaid revenue. So what do? We've actually got too much revenue, therefore we have to debit rent revenue in this case of $620, right? And we've got this other account called unearned revenue or prepaid revenue. It doesn't really matter what you call it. They both mean the same thing, but it's not yet due. It's owed to the next accounting period, if you like, that logic. Therefore, we've got to make that adjustment. What I'm going to do is again show you how this plays out in the ledger accounts, because I think it's probably easier to understand that way. Let's just click to the ledger accounts. What I've done here, the rent revenue, during the year we had 12 payments at $620, which amounts to 7,440. Then the last day of the month, I presume we paid cash at bank for it, 620, but it relates to the next accounting period. Therefore, we must take it out of rent revenue and put it in unearned revenue, okay, to do the proper accounting. So here we've got unearned revenue, not spelt right. There we are. But $620 must be put to that account, or take it off account. So it basically means that you still got 12 months of rent in that account. And that's what is allocated, should be allocated to that accounting period. And that other amount here for $620 is a current liability that, another way of putting it, we owe it to the next accounting period, so it sits there, so we can do the proper matching with revenues. I'm hoping that's been helpful to you. Follow it through step by step,